In this video, we want to observe the dangers of timing the markets, and why is it so difficult. Let us consider point number 1 here: unpredictability of the markets. Unpredictability of markets. And this will incorporate, external factors as well as market sentiments. When it comes to external factors, financial markets are influenced by a wide range of unpredictable events, such as economic reports, interest rates, and political shifts, as well as global crises. So predicting these influences if you can actually predict this influence, then you should be able to time the market. But unfortunately, no one can predict these factors accurately. And so predicting these influences and their timing is nearly impossible. This is why you can accurately predict these factors. And that makes market timing, an exercise in futility. So when it comes to market sentiment, investor psychology and collective sentiments can cause market movements that are not always tied to fundamental data, making short-term prediction unreliable. As long as the prediction is not really tied to or based on actual company fundamentals, then it can't be considered as reliable. Number 2 is emotional decision making. And this will involve fear and greed. During market downturn, fear can prompt investors to sell off assets, locking in losses. That is, they buy high and they sell low. Conversely, in a market rally, greed can lead to buying an inflated, you buy at inflated prices, risking overpaying for investments. So you discover that greed has its own effects, and emotion always fear equally has its own effect. So the next one is chasing performance. So in this case, you discover that in an attempt to capitalize on rising prices, on rising stock prices, investors may buy into a rally just before it gets to the peak, before it peaks, and resulting in potential losses when the market corrects. The market will always correct, And not only that, similarly, they may sell during a market dip, missing the rebound. You sell when the market is going down, and you miss the eventual rebounds up. So it's difficult. That's why market timing is dangerous. Number 3 is missing the best days. When you miss the best days in the markets, it will affect your overall returns. So impact of missing key market days. Let's look at what statistics is revealing to us. So studies have shown that missing just a few of the market's best performing days can drastically reduce your long-term results. All right. So market recoveries often happen rapidly and unpredictably, making it hard to know when to re-enter the market. Let's take, for instance, you're out of the market, in those 3 best market days. That means you've missed a significant rally in the market. You are out of the market because you want to time the market, and then you miss those 3 best days in a year. It shows that you're not going to really have a sizable or an outsized level of returns. Example, if an investor tries to time the market and misses the 10 best days of the decade, they may experience far lower returns than if they had remained invested throughout. So don't time the market. Don't leave the market because you want to get it right. Number 4 is transaction costs and taxes. In this case, it will attract high costs because frequent buying and selling can incur higher transaction costs or fees. And of course, the tax liability is equally there, which can potentially eat into your profits. And then capital gains. You will also incur capital gain taxes. Short-term trading often results in higher tax return or higher tax rate or capital gains compared to holding your investment for a long time. If you hold your investment for over a year, you'll be taxed at a lower rate compared to holding your position for less than a year. It will incur higher capital gain tax. Number 5 is overconfidence and information overload. Overconfidence and information overload. So in this case, you look at misjudging market trends. Investors often believe they can predict market movements based on limited information or anecdotal events. So overconfidence can lead to poorly timed decisions and subsequent losses. When you become overconfident, it's a likelihood that you may not judge or analyze the current events effectively or accurately. The next one is conflicting signals. In an attempt to predict markets, investors may be overwhelmed by conflicting analysis and advice, leading to confusion and indecision. You are paralyzed by analysis and information overload. You don't know precisely what to do or what not to do because you want to time the market. Why don't you just take a long-term approach and forget about this issue of market timing? Something you can accurately, you cannot get right most of the times. Number 6 is lack of long-term focus. Please subscribe to this channel and like this video. Lack of long-term focus. So in this case, is that factor, that issue of having a short-term focus. So focusing on a short-term market movement can distract from long-term financial goals like retirement, savings, or wealth building. These misalignment can cause investors to abandon well thought out plans, potentially missing long-term growth opportunities. They are short-sighted. They are guided by short-term noise in the market, and they forget the fact that the market is a compounding machine. And so the next item here is why is it difficult to time the markets? Why is it difficult to time the markets? Number 1 is complexity of prediction. Complexity of prediction. Accurately predicting market movements requires understanding a complex set of variables, many of which are unknown or unforeseeable. We have known, you have known unknown. You have unknown unknowns as a complex part of of ignorance. So how can you really time the market if you don't even know the unknowns in the market? So there's volatility. Even if you can predict a market trend, short-term volatility can make it difficult to execute a market timing strategy without suffering losses. Even if you are, maybe by experience, you know precisely when a particular trend will be down or up. But even at that, you may not be able to adequately or accurately, go into the market and exit the market. And we have long-term growth. So historically, the best returns from investing have come from staying invested over the long term rather than trying to time individual market movement. I know of an investor, the late Philip Fisher. We're told he held the stock of Motorola for about 40 years. Super long-term investing. All right. And so in conclusion, market timing is difficult because of the unpredictable nature of financial markets, emotional biases, transaction costs, and the challenge of accurately predicting future movements. So instead of trying to time the market, most investors are better off focusing on long-term strategies like diversification and dollar cost averaging, and holding investment through market fluctuations, and holding tight to your investment through market fluctuations.